Hello everyone, this is Meina, your crypto friend. For this week's CryptoMeina and Bitpush weekly Web3 news series, I will talk about the bankruptcy of FTX, Enron lawyer taking over as CEO, Bitcoin falling to 2-year low, and White House saying crypto needs to be regulated. In the past week, the crypto space has witnessed the most sudden and destructive giant collapse. After Binance its abandonment of the acquisition of FTX, on November 11th, FTX announced that 134 FTX-related entities had filed for bankruptcy protection, and Sam Bankman-Fried resigned as CEO. John J. Ray, a well-known lawyer who handled the Enron scandal, took over as CEO urgently. Court documents shows that Alameda Research alone has more than 100,000 unsecured creditors. The collapse of FTX led to a broad-based fall in the crypto market, with Bitcoin down about 20% in the past 7 days to a 2-year low. Former U.S. Treasury Secretary Lawrence Summers commented to Bloomberg, "This is classic financial fraud, and I would compare it to Enron." White House spokesman Jean-Pierre said Thursday that cryptocurrencies could harm ordinary Americans without proper regulation, and the latest event underscores those concerns. The White House will continue to monitor the development of cryptocurrencies. Several crypto firms, including Coinbase, Circle, Tether, and Maple Finance, have denied any high-risk exposure to FTX. However, similar to the Terra Thunderstorm situation, the shockwave of FTX will continue to spread. I also uploaded my full coverage video of the FTX collapse on my YouTube channel on November 12th. The video link is attached in the description. Please watch the video if you are interested in learning more about the impact of FTX bankruptcy on the crypto industry. I have also invited industry leaders to comment on the collapse of FTX.
My name is Wilfred Daye. I started my career on Wall Street. Initially, Lehman Brothers in commercial real estate, and I worked through, the sort of 9/11, and it was very hard to do business in real estate. I moved to credit derivatives right after. I stayed primarily my whole career in credit derivatives space at Barclays Capital, Deutsche Bank, and UBS. I left the banking space 2016, and got into crypto through building a cryptocurrency related banking infrastructure. It's called Noble Bank. So we were the first crypto bank in US under IFE, it's called an international financial entity. And then worked with folks at the OKEX to run non-China business as the head of financial markets. Ran OTC business at the McCoy Capital. And recently, I joined Securitize Capital as a CEO there.
Great. It's very interesting that you are very deep both in the traditional finance and the crypto world. So my next question is, how do you view the potential future regulation imposed on crypto after the FTX bankruptcy event?
Yeah, this is a very good question. This is a very hot topic at this point. So let's go back, a little bit here. FTX primarily is an offshore exchange. What I mean by that is they generate most of their revenue internationally, cater towards non-US investors, and they have a group of FTX has a group of entities that's focused on US investors, so FTX US, FTX US derivatives, which is actually DCO. So from regulatory perspective, we actually need to think about the problem from both onshore and offshore component of it, right? On the onshore component of it, you have a number of regulated exchanges or marketplaces, such as Coinbase. Coinbase is a listed marketplace focusing on peer-to-peer transfer of cryptos Those are under the license called a money service business. So each state will give the license to Coinbase. And in New York is even special. It's called the New York Bit license. So this is all regulated entities. So not only Coinbase, but there are other guys like Gemini and so on and so forth. Right. So those are the regulated entities. They have the sort of they have the prime brokerage business. They have the custody business. They have the sort of exchange active traders type of GUI that cater towards the retail customers. So that's the onshore. Now, offshore basis, there are a number of cryptocurrency exchanges or marketplaces, such as OKX, Huobi, such as Binance, BitGet, such as there's a bunch of the sort of offshore exchanges out there. Most of them are lightly regulated or unregulated. This is because each jurisdiction has different regulation, right? So if you think about the exchanges domicile in Seychelles or Cyprus or Malta, each jurisdiction has their own understanding of the cryptocurrency rule set and risk. So the issue we're seeing with the FTX is actually related to the offshore entity. Specifically, it's a consequence of commingling market-making activities with exchanges, right? So let me go back to explain what is a market-making activity. So in U.S. equity, whenever there's a new product going on in the market in exchange, there are exchange-designated market makers. Those are the regulated entities, the participants who support the bid-ask or maintain the volatility of a specific company, equity in this case. Similarly, in cryptocurrency, you also have market-making activity associated with Bitcoin to USDT, Bitcoin to USD, and so on and so forth. So each currency pair or each cryptocurrency pair has a designated or dedicated market makers. So Alameda is one of the oldest and the most reputable market maker since 2017. So much of the risk exposure came out of Alameda rather than FTX. So as the exchange business, the exchange business model is simply taking the sort of like commissions when people trade. So by definition, there's no risk, right? However, if you run an exchange that has a lot of leverage, or the products themselves are leverage, let's say that you have a futures product, investor investing in a futures product, but with a margin. If the margin is 10% of the notional of the futures, and then the market, when it goes against the investor could get liquidated, right? So that liquidation process typically is automatic, meaning that if the code sees the investor in red or about to be liquidated, or the equity does not support the amount of risk he's taking, the position will be closed out completely. So there's a close out process. In the case of Alameda, again, is kind of unknown at this point, but in the industry, we know Alameda internalize the order, meaning that they take over the orders and put on their books. Yeah, so I think the risk is actually within the Alameda. Now, from regulatory perspective, the obvious you want to see every jurisdiction wants to see the market making activity inside the exchange. It should be segregated away, meaning that there should be no relationship between the market makers themselves and the exchange they support, right? Except the sort of the commercial relationship. And in the case of Alameda, obviously Sam seems to from the media seems to that direct assets to make up the losses for Alameda, which is a different division of his empire, of cryptocurrency empire. So that's one sort of changes that should happen or could happen, and then in the sort of offshore exchanges, right? Doesn't matter which jurisdiction, the market making activities should be segregated from the exchange business itself. Now, second thing that should happen, and then it's pretty obvious to a lot of people, is segregation of balance or accounts away from exchanges. Now, I don't know if you use the Binance or if you use any other exchanges out there. Whenever you deposit your dollars and buy Bitcoin, your Bitcoin sit with the exchange, right? and the exchange provide function as a custodian for your assets. The function, the custodial function should also be segregated away from exchanges. Like I mentioned, exchanges business model should only be matching orders and taking the commission, not holding assets, right? And because if an exchange default, it holds assets, the customer's assets, again, in this case, not segregated, will be at risk. And this is absolutely true in FTX because the assets are not segregated from the exchange, and you have a million customers' assets tied up with FTX, the bankruptcy. So this needs to be changed, and the regulators are actually looking at this very heavily. So in U.S., when we come to onshore markets, the custodians are holding segregated accounts from the exchange themselves. And then again, regulators in onshore U.S. regulators are pushing to make sure that everyone will have this infrastructure, this structure. So meaning that you have when you trade. After you receive your asset should leave. You should leave your assets with a third-party custodian or a segregated account, right?
So that's quite important. That's the second. What about those offshore entities?
Yeah, on the offshore entities, need to be segregated as well, like I mentioned. So I do not know specific jurisdictions will push for it, but most likely everyone will push for segregation of accounts, even for offshore exchanges, and that it should happen, right? Another point that's quite important within the sort of offshore exchange arena is something called a proof of reserve. Proof of reserve is a blockchain-based audit to show that the exchange has enough assets on the balance sheet to meet one-to-one bank draw, deposit versus the obligation, asset versus liability, right? And that's currently going on right now. It's not really a focus from a regulator's perspective, but this is more of all the sort of a self-motivated from all the exchanges, make sure that they wanted to pacify the customers risk, right? So they want to prove that they have enough asset to support the withdrawal and so on and so forth. So that's going on today. So as we're speaking, so next couple of weeks, you'll see more proof of reserve activities for all the exchanges. But yeah, so I think from a regulatory perspective, not only onshore regulatory perspective, not only CFTC will look at it closely. The White House has already made an announcement that they will focus on the cryptocurrency regulation. So next, let's call that 12 months to 18 months, there will be a lot of regulators coming examine the cryptocurrency ecosystem, the industry onshore, but also push more pressures for offshore regulators looking at various offshore exchanges.
So one last question to follow up is, do you think those new regulations or the upcoming rules gonna set back DeFi?
This is a very interesting question. So given our experience through Luna, sort of fiasco, through Arrow, and today with FTX, because of the fact that DeFi relies on smart contract, and a lot of lending activities on DeFi is on-chain, is visible, is transparent, and the liquidation engine built on DeFi is automatic, meaning that it's all machine-driven, right? It's going to the robots and so on and so forth.
Yes.
So if you look at Celsius, when Celsius, right before the Celsius declared bankruptcy, got into issues, the first thing they've done is actually flatten out their risk on DeFi. In the case of FTX, the same thing. FTX actually, make hold to the collateral on-chain lending protocols first before they get to gating the withdrawing on exchange and so on and so forth. In practice, it sounds like the DeFi become a de facto senior risk to the debt, the equity on the exchanges. So DeFi is actually relatively unscathed in given the current set of events. However, DeFi's volume become lower because of some of the coins, governance tokens, has lower price compared to a week before, right? This is just because the whole general market went down significantly. or the protocol use DeFi and then needs to recapitalize other part of business and they withdraw from the DeFi. So you can see that the total volume locked on DeFi went down significantly in last week or so. But in general, DeFi is unscathed. Given the regulation that we see in the future, I think it's very interesting to see how DeFi will grow, compete against CeFi, right? At this point. But I think DeFi will definitely survive, and it'll survive in a different form. It becomes stronger and stronger. So it is an important part of the cryptocurrency ecosystem.
Thank you for watching. See you next time. Bye.